Okay, let's shift to private if you're good for time. Um, how significant has the shift been from public towards private over the recent, I don't know, couple decades?
That's huge. I mean, the flows have been dramatic. So the flow, I don't know, I don't have the latest numbers, but probably the last 15 or 20 years, it's been north of 2 trillion into out of uh, active management, right? And but I just to level set with all the listeners, and I think these numbers are going to be roughly right. Our calculation, and this is for the U.S. again, that active public equity managers run about $38 trillion. I just want to give people like lay of the land.
Okay.
$38 trillion. So the overall market's like 63 trillion, and about 60% is run by funds, and 40% is held personally or whatever. So 38
Hmm.
trillion, call it roughly. Buyouts, our estimate is the assets under management are about 2.7 trillion, and for venture capital, about 1.3 trillion.
Okay.
Okay, so let's repeat that: 38 trillion, 2.7 trillion, 1.3 trillion, right? So notwithstanding that there's been a big push into privates, just to be clear that the order of magnitude is vastly larger for publics. One little fun datum on this is that, NVIDIA's market cap went up $2 trillion last year, right? So NVIDIA's market cap went up more than the
Yeah.
AUM for the total venture capital industry, right? So just to put that in a little bit into perspective. Now, I do think that there's the shift away from public equity has been we already talked about this, most pronounced with endowments and then pension funds. I think it's not obviously been for a bunch of reasons, including regulatory reasons, not huge for normal investors. But yeah, no, it's been a very significant shift.
And the main causes being,
I think there are a bunch of things. One is we obviously were going through this very low interest rate environment, and when you run a pension fund or an endowment, you have beneficiaries you have to serve, and as a consequence, you need to get returns. And so one way to get returns is to go out on the risk spectrum. Venture does that through buying young companies right, with uncertain prospects. Buyouts do that through leverage, so buying companies that are more stable but with leverage. So that would be one. Second is there has certainly been a rise of sophisticated investors. So just the sophistication of the industry has increased quite a bit. The third thing is there have been very substantial regulatory changes, and in particular, some regulation changes in 1996, which allowed more people, more investor classes to access privates. And then finally, the last thing is, and this is more, kind of muting the flow into public markets, is that there's just more access to capital for private companies. And, Cameron, as you know, in the United States, the number of public companies is sharply lower today than it was, say, 20 years ago,
sure
30
is.
years ago, pardon me, 30 years ago.
Yeah.
And in part, it's because companies are staying private longer. And the reason they're staying private longer is because they can, right? They're getting access to capital in a way that was really not practical a generation or two before. So I think those are some of the reasons. The question is you might want to ask is, to what degree do these things reverse? If interest rates are much higher, you can satisfy a lot of your future liabilities through, like credit or more plain vanilla equities. That would be interesting. So, yeah.
How do you articulate the benefit that private equities offer investors over public?
Maybe two or three things I would talk about. One is, the managers have much more control over the businesses that they own, right? They're not just agents, they can be to some degree principal. So if you're a buyout fund, you own the company, you can make changes, change management, change strategy. Activists can do that in public markets, but it's obviously a much more onerous process. Venture, of course, same thing with control. I mean, you own a stake, but you can work with the entrepreneur, you can introduce him or her to various folks and so forth. So the control thing, I think, is a big part of that. By the way, there's almost always a reasonable trade-off between control and ownership. So if you have small ownership, it's hard to have control. If you have lots of ownership, you have more control. So that would be one. Second is what we already talked about, lots of dispersion, right? So if you are skillful and you can find the right companies, you have a lot of opportunity there. Interestingly, the persistence we talked about a moment ago, but persistence is idea. Again, if you performed well in a prior period, what's likely you'll perform in a subsequent period. Persistence, there's very low persistence in mutual funds, for instance. There's relatively low persistence in buyouts. But one area where there remains a lot of persistence is the one asset class with tons of dispersion, and that's venture. So if you can get access to the leading venture firms, which is very difficult to do, but if you can get access to those folks, that dispersion and those high returns are going to be wind into your sails. And then maybe the last one I mentioned is a little bit more controversial, but it's a little bit of keeping you from yourself, right? A lot of people call this volatility laundering, right? But the idea that you, to some degrees, you can make your marks subject to some sort of model or something like that, and so the volatility appears less than it probably is if you were to had to monetize all these things from one moment to the next. And so, and then lockups, right? So as a consequence, the limited partners, the people who invest with these general partner buyouts or venture, it just doesn't feel as such a dramatic roller coaster ride as it probably is in reality. And the fact that you have a lockup means you have to sit on your hands whether you like it or not. So those things kind of keep people in place and allow them to ride out the storms, and with a little bit of a psychological benefit that pretend that the volatility isn't what it really is. And so I think those are some of the factors. I think the last one, I don't know if I'm going to call it a benefit in some ways, but yeah, but it is kind of a benefit because it gets people to stay in their seats.
I think that was another Cliffism, wasn't it? Volatility laundering.
It is, exactly. He's good. He's good at all that stuff. Yeah.
He's exceptional. Okay, here's another great Ben question. What role have intangible assets played in the rise of private equity?
This is a really interesting one, Cameron. I mean, again, I'm not that close to this, but when I started in this industry in the 1980s, that was sort of the first buyout wave. And you remember RJR Nabisco and Beatrice, and there's some of these famous deals. And the sort of earmarks of those deals that they were big companies with good cash flows and visible assets, and so and a lot of the strategy was to break them up and sell off the pieces and so forth. And so tangible assets are things that were very you could touch and feel were a really important thing. I don't know the exact numbers now, but I want to say something like 20 to 25% of all buyout deals now are in software.
Wow.
And that would have been completely, if you had told me that was going to be the case in the 1980s or even early 1990s, I would have told you I didn't believe you, right? And it's a little bit for the reason we talked about before, because if it doesn't work out, what's the asset value, right? If your industrial company doesn't work out, you've got assets, and at least there's some salvage value, and you can get some recovery on the bonds or whatever it is. But if it's all intangibles, okay. Now that said, one day I got to go back at this, but I one day try to see, in the case that there is distress in buyouts for a tangible versus tangible business, what does that mean for the recovery of the bonds, right? So the equity's gone, right? But what does it mean for the recovery bonds? And if my memory is correct on the academic work on this, and there are only one or two papers on this, is that the actual recoveries were not that dissimilar. So that was almost like a myth, well, I don't know if it was a myth, but it was a belief of mine that got updated, that perhaps there is more recovery value than. So that's another thing. I would just put a tab in, like keep an eye on that, because that's an interesting development. If in fact the recovery values are the same for tangible versus intangible businesses, that changes essentially the nature of the buyout business.
What do current private market valuations say about expected future returns?
I just don't know the answer. This is a little bit like the same thing with the Cape. We put it in our report, and Dan Rasmussen of Verdad's talked a lot about this. There was a chart, and I think I got it from Steve Kaplan, University of Chicago, which basically showed the EBITDA multiple paid for a business and the PME, public market equivalent return.
Yeah.
Right. So higher is better, lower is worse. Okay. And so with that chart, if you can imagine it, is as the multiple went up, the PME went down. So the regression line goes from the upper left-hand corner, high PME, low multiples, to bottom right-hand corner, which is, low PME, high multiples. And it seemed like the magic number was 10 times multiple, right? Now, that said, PME multiples, if I saw this correctly, multiples are now in buyouts running into the mid-teens, right? So we're in completely uncharted waters from that point of view. So I guess the best answer to that is time's going to tell, right? Time's going to tell, but I just don't know.
Okay, so you said companies are staying private longer and there's fewer public companies. Can we extrapolate from that investors need to have some private equity now to keep up diversification, keep up expected return characteristics?
It's a good question. I mean, I think that when you look at of the population decline in public equities, there are sort of 2 points on this. If you look at the population decline, about two-thirds of the companies that went away were effectively very small or micro cap. So they're really, it's like the bottom 2% of market cap. So they're
Okay.
really not that really investable for certainly for an institution. And then the second thing is to say, interestingly, just like obviously how the math works, if, Delta Airlines acquires Northwest Airlines, the number of public companies goes down by one, right? Because it's cut in half, but the assets are still out there, right? It's just a bigger company. So the effect is much less dramatic if you look at the aggregate invested capital than if you look at the number of companies. In other words, saying this differently, the companies that are around are bigger than they used to be.
Mm-hmm.
And so now whether that, how that speaks to diversification, that may be a slightly different question. But I think that even with however many companies we have now, 38 or 3,900, there's ample opportunity. Now, the other thing to say is these are interesting points. Like, look at the big, who are the big unicorn companies these days? SpaceX got a $350 billion market valuation, the Databricks at $62 billion, Stripe at $70 billion, right? These are decent sized, they would be decent sized public companies, right? To state the obvious. And so you could make the argument that, that first set of tens of maybe into hundreds of millions of dollars, billions of dollars, pardon me, were in the private market. And again, you and I, as regular investors, couldn't get access to that. So it's almost like a fairness question. Should we have gotten access to that? Versus you look at something like an Amazon.com, which went public in 1997, and in effect, I don't know what it was. Inflation adjusted is probably like $300 million market cap, and the market cap today is north of $2 trillion. So essentially, 100% of the wealth has been created in the public market. So you could have participated from day one and gotten all the upside in that. So yeah, that's an interesting, I think there's a fairness question. Now, the flip side is, and I think it does seem like there's some movement toward making private markets more accessible to more people. The question is whether there's a degree of sophistication that is useful or maybe even necessary to participate in these things versus just, buy whatever everybody thinks is hot.